Thanks, Doug. Good morning, and thank you for being with us today and your interest in Walmart. This will be the last time that I address our annual investor meeting, so it's kind of bittersweet. But I really feel fortunate to work for such a great company with a lot of great people, and I've also really enjoyed working with all of you over the last 10 years. I'm excited for my successor, Brett Biggs. If you've been around me any length of time, you know that you've heard me talk about how important our talent development and succession planning is at Walmart. Brett is a great example of that. He's extremely talented, and he's definitely ready to take the CFO role. Many of you know Brett already, but if you don't, make sure that you meet him today. Now, before I dive into the details of the future guidance, I'd like to give you an update, a financial update on what the guidance scorecard from fiscal year 16 would have looked like that we set out for you last October. We've experienced increasing sales momentum in our Walmart U.S. business, and we continue to see improvement in our customer traffic. However, the impact of currency on our total global growth has been much stronger than we anticipated a year ago. We now believe that our total net sales growth will be relatively flat for fiscal year 2016. It's important to note that if we exclude the impact of currency, our total net sales growth would be around 3%. And that would include Walmart U.S. growth of around 3.5%. Now, as we told you last year, we plan to invest in new technologies, specifically including e-commerce and digital capabilities. We've also announced earlier this year a significant investment in wage rates and store hours. Now, these investments have resulted in an increase in operating expense and a decrease in operating income. And operating income has been negatively impacted by a decline in gross margins in Walmart U.S., as we discussed in our second quarter earnings release. Now, in the first half of fiscal year 2016, we generated, though, around $5.1 billion of free cash flow. We know we still have more room for improvement, but that's a pretty strong cash flow. So now that we've updated fiscal 16 guidance, the scorecard, let's move on to the longer term plans. Now, as Doug mentioned, our strategic priorities that you're going to hear about today are about winning in our stores in the U.S. And we'll do this by continuing to focus on strengthening the supercenter format, optimizing our neighborhood markets. We'll focus on adding capabilities to our supply chain by building out the fulfillment network to create a seamless customer experience, as Doug just mentioned. Now, and finally, we're going to build a digital relationship with our customers through improved site experiences and apps, but also enhanced store experiences. Before we wrap up today, I'll also provide an update for our share repurchase plans. Now, in the past, we've given you one-year financial guidance as it relates to our strategies that we've laid out. Today, we'll give you more insight into what we see our performance will be over the next 3 years. And it's going to include sales growth, earnings per share, cash generation, and we'll also look at how we're going to use our cash, namely CapEx and shareholder returns. Our focus today, though, is Walmart U.S. and our e-commerce business. Now, there are some areas that we won't discuss today in detail, the first being our portfolio. You heard Doug talk about it. We're open to reshaping our portfolio, and we'll be reviewing all of our operations, including businesses and stores, but we'll be smart about it and ensure we drive shareholder value in all of our decisions. We'll provide updates on this topic as and when there's more information. The second item relates to international, including specifics on the opportunity in China. The third is Sam's Club. And we'll have Dave Cheesewright and Roz Brewer come back and meet with you at a later time to share more details about their plans. So let's start with sales growth. Now, Doug mentioned a number of points that I'll cover in more detail. We're in an investment phase right now, and we need to invest in order to change our trajectory. We're focused on winning with our customers and growth. and our geography does matter. Now, you may remember that I talked about our focus on the U.S. this time last year, as the shifting dynamics played and will continue to play a large part in determining how our plans are built for the future. You know, if we step back and look at the sales growth in 2012, you can see how International and Sam's Club combined were contributing over 3/4 of our total company sales growth. But in the subsequent years, Walmart U.S. has become an increasingly large part of that growth story. And as an example, within fiscal year 2016, Walmart U.S. has turned traffic and comp sales from negative to a positive. Our long-term plan projects the continuation of that positive momentum, reflecting around 100 basis points of further improvement in our annual sales growth and performance on a constant currency basis. Now, as a result, our annual sales growth for the next 3 years will add approximately $45 to $60 billion of new sales. $45 to $60 billion. Now, that's an annual growth rate of 3 to 4%. Kind of on the same lines what Doug just said, that incremental $45 to $60 billion, that's the equivalent of a Fortune 50 company. Now, as a reminder, all of our e-commerce sales are embedded within the business segments. But if we show the growth projections for e-commerce side by side with the segments, you'll see that we expect this business to be an increasingly significant growth engine over time, pretty consistent with what we've told you in the past. It's important to note that the operating losses will reduce over the next 3 years. You will hear more specific details from Neil and Greg today on how we'll drive this growth through our investments in this seamless customer experience. Now, in August, we provided an earnings per share guidance for fiscal 2016 of $4.40 to $4.70. Now, this range included updated assumptions for the impact from our wage investment of 24 cents. Incremental investments in global e-commerce between 6 and 9 cents, and the impact of our headwinds from shrink and pharmacy of around 11 cents. Now, our range is wide, wider than probably usual because of discrete items, including the uncertainty as to whether Congress will pass the legislation on certain tax extenders. And whether this legislation is enacted will have a significant impact on that effective tax rate. And as you know, we provided guidance earlier this year that the tax rate would range between 32 and 34%. If the legislation is passed, we'll end up closer to a tax rate of 32%. However, if not passed, we could end up around 34%. Now, before I move off this slide, I want to take a moment to talk about how our sales mix is also impacting our profit. Within Walmart U.S., our business mix has shifted between formats driven by customers' desire for convenience and also by category as our mix continues to skew towards grocery and e-commerce. And this is important because of the effect on operating margin percentage. If you look at our underlying trend, you will see a reduction in the operating margin rate driven by our focus on meeting our customers' changing needs and the related format and category shifts. Before we look at the 3-year horizon for earnings per share, let me remind you that fiscal year 17 will be the second year of heavy investment for us, both in store wages and in e-commerce. This past February, we announced an increased investment in our associates through wages, training, and store structure. With this announcement, our hourly start rate moved to $9 per hour this year, and it'll move to $10 per hour next year. This program will result in increased cost of about $1.2 billion this year and an incremental $1.5 billion next year. Now, this is $2.7 billion of investment over a 2-year period. In fact, in fiscal year 2017, this wage investment represents approximately 75% of our earnings per share reduction. Now, additionally, we'll be making other operating investments within the stores, such as pricing and online grocery. You're going to hear more about that from Neil and Greg. With that information in mind, fiscal year 17 earnings per share will decrease by between 6 and 12%, driven by these heavy investments I just highlighted. But let's look a little farther out. By fiscal year 19, we believe our earnings per share will increase by around 5 to 10% against that previous year. Now, earnings per share it will be impacted by a combination of operating income and share repurchase, and I'm going to address share repurchase in just a minute. I've already covered reductions in operating margins driven by our wages and e-commerce investments, but I want to call out the other large investment, pricing. Over the next 3 years, we will invest several $billion into price. Our plan reflects some investment of price in fiscal year 2017, with the majority of the investment reflected in fiscal years 18 and 19 after we implement the wage investment. I want to clarify here, our plan reflects us resetting our financial base. These investments, along with the improvement of our e-commerce operating losses, will provide a sustainable foundation upon which we can provide profitable growth. We expect operating income percentage to bottom out during fiscal year 2017, and we anticipate margins climbing back to sustainable rates by fiscal year 2019, and they should remain relatively flat after that. Now, the results I just covered will continue to generate significant cash flow. Over the last 3 years, we've generated approximately $75 billion in cash. Over the next 3 years, we plan to generate around $80 billion in cash. Now, while we assume some progress in working capital in our plan, we're going to continue to look for opportunities which we think we have for further improvements. So let's talk now about how we plan to use that cash over the next 3 years. You may have heard me say before how we prioritize our cash. There's 3 ways. The first, growth. The second, dividends. The third, share repurchase. These priorities are supported by a very strong balance sheet and cash flow. Now, we're focused on capital allocation and ensuring it's aligned to our strategic priorities. For our capital to generate good returns, we know we must use it wisely, and we have to prioritize how we spend it. So let's start with the investment in CapEx. Now, our plans for the next 3 years reflect a reduction in capital expenditures. For fiscal year 2017, we plan to spend approximately $11 billion, and we expect to keep capital expenditures relatively flat through fiscal year 2019. For Walmart US, our capital expenditures will be down approximately $800 million, driven by the moderation of supercenter and neighborhood market growth, while we focus on assessing the format to ensure it meets our customers' needs for price, assortment, access, and experience. And you're going to hear more from Greg about that in just a minute. Now, international will show a decline of approximately $500 million as we evaluate our strategic priorities around the globe. Sam's Club will remain relatively flat as they continue to focus on strengthening their core business. And once again, as a reminder, global e-commerce is embedded within our segments. Our total e-commerce and digital capital expenditures will be approximately $1.1 billion in fiscal year 2017. That's related to our commitment to invest in technology and our fulfillment networks that we told you about a year ago. Now, it's important to note these numbers do not include acquisitions, and they're based on the landscape as we see it today. The numbers could change prior to or during a fiscal year, and as we react to strategic opportunities, we will come back and update you as we have more information. There could be projects that could provide incredible customer offerings and drive shareholder value, and we would make those investments. And additionally, if we identify an acquisition that would be accretive to the company, we would take advantage of that opportunity. Now, we believe during this investment period, it's critical to continue to deliver a return to our shareholders. So let's move on to shareholder returns, dividends, and share repurchases. As we've shown in the past, we remain committed to a good dividend to our shareholders. I can't tell you what the dividend's going to be going forward, but I want to remind everyone that we've had a dividend increase every year for the last 42 years. We are very proud of that record. I think it demonstrates our commitment to dividends and shareholder returns. Now, talking about share repurchase, as a reminder, over the last 3 fiscal years, we repurchased approximately $15 billion of our shares. Now, we've always remained committed to our strong balance sheet and said we would only use it for strategic purposes. And last year and this current year, we've not utilized that capacity as we've not felt it was the right time to drive a larger volume in share repurchase. However, we believe in the current landscape provides us a unique strategic opportunity to utilize the capacity of this strong balance sheet and cash flow. At the current time, we have approximately $8.6 billion remaining under our current $15 billion authorization. As part of our commitment to drive shareholder return, I'm pleased to announce that our board of directors has authorized a new $20 billion share repurchase program and the retirement of the remaining balance under the 2013 authorization. Now, our intent would be, with all else remaining the same, to utilize this authorization over 2 years. And that assumes no large acquisitions and no significant changes in planned operating cash flows. We believe this new authorization demonstrates the company's commitment to our plan. So, what does it mean when you put it all together? Well, if we take a look at the key metrics we're forecasting for fiscal year 2017, along with fiscal years 18 and 19, we anticipate adding $45 to $60 billion in sales for that period. Earnings per share will decline in fiscal year 2017, driven by our investments in wages and price. But by fiscal year 2019, earnings per share will grow to a level above where we are today. Let me say that again. I think it's very important. In fiscal year 2019, our earnings per share will grow to a level above where they are today. And by the way, our earnings per share for 2019 would be around where they are today, excluding the $20 billion share repurchase. Even with these investments, we plan to have strong cash flow, and we'll continue to use our cash to reinvest in the business. Now, capital expenditures will be approximately $11 billion next year, and they'll remain relatively flat for the next 2 years after that. We remain committed to delivering strong returns to our shareholders through our dividend and share repurchase programs. That concludes my presentation. And let me remind you, we're going to have one overall Q&A session. That's going to be after all 4 presentations. Right now, let's take a short break. We'll hand out the press release, then we'll come back and start up with Neil, who's going to walk you through our detailed plans for e-commerce. Thank you.